Hi, this is Brian with your Q4 2024 update. And remember, at Leelyn Smith, we try to reach client goals with the least amount of risk possible. Okay, our first video of this year was titled Normalization because 2024 was considered to be the final year of the post-COVID healing, economic healing, and getting our economy back to normal. And after 2 years of tight monetary policy, where the Federal Reserve was fighting inflation, earlier this month in September, they reversed course and they are now entering into an easing of monetary policy. At the September meeting, they reduced the federal funds rate by 50 basis points, which was a little larger than some expected, but still within reason if you were paying attention to Chairman Powell's remarks, which we will explain. And we'll also explain one major factor that the financial media largely missed, not fully, but largely missed. And then we'll talk about what that new policy is and how that affects our portfolios. So let's jump in. So in early 2022, the Fed started a monetary tightening policy where they were increasing interest rates in an attempt to fight inflation, which is half of their dual mandate. They were trying to slow the economy down. Now, unemployment, which is the other half of the mandate, was below their 4% target, so they had room from the unemployment side to raise rates, and hence that's why the policy is the way it was. Now, this month in the meeting, Chairman Powell mentioned that risks to achieving inflation and unemployment goals are in balance. And what he meant by that was that inflation and employment concerns are about equal now. It's no longer just about inflation anymore. By the way, this is part of the normalization process. So what is that new policy? The new monetary policy is of decreasing interest rates because unemployment is now above that 4% target rate that they have. And inflation has largely been tamed. Now, this is the part that the financial media mostly missed. The Federal Reserve does deserve credit for some of this. There's another part that they didn't mention, which is the decreasing of unit labor costs due to increased in productivity was also in play and helped bring inflation down. Now, we need to get inflation down more than they're mentioning, and we need to get it to a neutral rate. Therefore, a 0.5 or 50 basis points drop in the federal funds rate was appropriate, as we need to do another full 1% or twice as much as we did over the next year or so to get to a neutral federal funds rate. So all this economic jargon out the door, what the heck does all this mean to us? So for us, it means one thing in particular: lower borrowing costs. So when you take out a mortgage, that's your borrowing, it's a loan. When businesses go to start their business or to take out some new business venture, they take out a loan. It's going to be cheaper to go get a mortgage or to take out a business loan or whatever other loan, and that should ignite some more of the economy. And as businesses have lower business costs, they can hire more people, which of course the Federal Reserve wants, hence them decreasing interest rates. Now, for the stock market, lower borrowing costs means about the same thing. It means all things equal, their earnings should increase because they have lower costs of borrowing, and therefore it increases the attractiveness of stocks. Now, there are risks to this. The Federal Reserve could cut rates too quickly or too much, thereby reigniting inflation. That's the first one. Second is that this is a presidential election year, and both candidates sound intent on creating inflationary fiscal policy, so that may not be in unison. We could see a melt-up, which is when stock prices, it's typically referred to in the stock market, is when prices go up too rapidly relative to their fundamental data because investors are piling in and just buying and buying and buying up. And that typically leads to a correction. Now, we've been through melt-ups before, and we know corrections are a normal part of the average market, so we want to be cognizant of the possibility that this may occur. But here's the bottom line. The monetary policy, this isn't the economy, but it does influence it. Workers, entrepreneurs, consumers, investors, that's the economy. But policies do have impact. Thus, we are cautiously optimistic, knowing that a correction might be around the corner because we view it as part of the normalization of the economy. And it appears that normalization is either complete or it's getting pretty close to complete. Okay, that's it for this time around. Thanks for watching. And remember, at Leelyn Smith, we try to reach client goals with the least amount of risk possible. Keep an eye out for our next video.